أستاذ جاسم،
أهلا وسهلا.
الله يطول عمرك. إذا مستعد إحنا راح نبدأ الآن. عليك أستاذي.
أوكي تمام نتوكل على الله.
أعزائي أعضاء الهيئة الأكاديمية، أعزائي الطلبة والطالبات، أسعد الله مسائكم بكل خير إن شاء الله. والآن ليومنا الأول من هذا الأسبوع ستكون لنا محاضرة قيمة جدا من أحد البنوك البحرينية المرموقة المعروفة من الليدنج أورجانيزيشن، ألا وهو بنك البحرين والكويت BBK. راح يتحدث معنا الأستاذ جاسم محمد العرادي، فليتفضل مشكورا.
شكرا.
طيب
اوكي. في البداية طبعا firstly welcome to this last session I think, and special thanks to the organizers, speakers, presenters and all the participants. I have the pleasure to be part of this Youth Connect Day. I hope that I can share with you some of the practical examples related to advanced accounting concepts. So let us make this the utmost use of our short allocated time and make this session as interactive and beneficial as we can. Expect some questions. I need your participation, please, because it's a little dry subject and it is our duty to make it interesting and little bit juicy. And today I'm going to cover three main topics. I'll give you introduction and basically would be covering the International Accounting Standards number 1, IAS number 1. And then I'll focus more on the consolidated financial statements that are governed under the IFRS number 10. And at the end, I would be covering the equity accounting method, which is IAS 28. I'm sure that you have covered the theoretical parts and the academic parts, part of your curriculum and studies. Today, maybe it would be like a good refresher for you. Plus, I'll be focusing on giving you some examples and some real life examples, and we'll raise some questions just to encourage participation. Okay, so basically, what does it, what IFRS means, and what are these IFRS? We hear the word IFRS, we hear the word IAS. So basically, these are accounting standards, and IFRS were issued by the International Financial Reporting Standards and ICEP, and this body, a governing body, have the authority to set IFRS and to approve interpretation of these standards. They are meant to be applied by profit-oriented entities. So any entities that are established for the purpose of generating income or profit, they should follow the IFRS standards. If they are not, they would be like a government accounting, fund accounting, and I'm sure that you have covered that part of your studies as well. So the basic purpose or the ultimate purpose of the financial statements is to give information about the entity, about the business that are very useful for the decision maker. And who are the user of this information are basically the stakeholders, whether they are investors, lenders, employees, credit agencies, regulators, and so on. Okay, can I raise a question? And feel free to participate, please. What is the difference between IAS and IFRS? Anyone? Is there a difference? Any hands? I'm sure you heard IAS even from my introduction, and you heard IFRS. Is there a difference between them? Maybe you know the difference between IFRS or the accounting standards when compared to the US GAAP. But now we hear the word IAS, IFRS. Is there a difference between them? To help you out, there is no differences. They are the same, in fact. It is only that the IAS were launched in 1973 and were issued or developed by the International Accounting Standards Committee, whereas the IFRS, as I mentioned, were developed by the International Accounting Standards. So they are the same. In fact, only a handful of the updates in the IFRS make the IAS redundant, meaning that many countries continue to follow IAS and differ to IFRS only when the two are different. I'll give you an example now. I'm sure you heard about IFRS 9. We used to apply as financial institutions or like business-oriented entities. We used to apply the IAS 39, that is to do with the measurement and accounting for financial instruments. But when the IFRS introduced IFRS 9, it has replaced the IAS 39. Another example is the IAS 16 that accounts for property, plant, and equipment. It was replaced by IFRS 17 that has enhanced the standards and has provided more guidance and clarification for accountants to follow. Next. Okay, so what are IFRS? I mean, we see a number of IFRS issued, and they are all about talking about conceptual framework for financial reporting. And this framework basically covers the basic elements and components that the accountant or auditors refer to. Basically, they will cover all these. I'm not going to read all this, but I highlighted those that we will be covering today, partially at least. The financial statements and the reporting entity. We will cover recognition and derecognition, measurement, presentation, and disclosure. Fine. Okay. So IAS number 1. Okay, what is it? It is concerned the International Accounting Standard number 1, the first issued IAS, maybe. It is concerned with the presentation of financial statements. It gives guidance on how they should be structured and what they should contain. Okay, so the standard is IAS number 1. It will give you guidance on to ensure comparability of presentation, to ensure that the entities that you are reporting about or measuring the performance of are going concern. They should use the accrual basis of accounting, except for cash flow, because the cash flow rely or depend on the cash basis. And this is important here. There is no prescribed format for financial statements, but there are minimum presentation and disclosure requirements. So the standards, even the regulators, they require the mandate minimum presentation and disclosure requirements that should be part of your financial statements disclosure. Whether it's quarterly financials, semi-annually, or annually. Very important to present the financial statements or information on a comparative basis so that you can compare to previous year, you can compare to similar industry, maybe that are in the same line of business. So this is important as guided by the standard. Let's test some of your knowledge now. I need your participation, please. Which one of the following does not comprise a set of financial statements? Who can tell? A, B, C, D. You know the financial statements, the set of financial statements. Which one of these does not fall under the set of financial statements? Any answer? No? Have you covered advanced accounting in part of your academic study, or? I'm just raising the question just to know, I mean, what, how deep or shall I go? Shall I go like briefly high level, or? You can write in the chat, by the way, if you don't want to raise your voice, you can put your comments or answers on the chat. Okay, I'll just review the chat. Answer is D. Yes, this is, sorry, D wrong, no. Another try. C. The answer is C, yes. Who answered it correctly? Mahmoud. Very good. Okay. Move to next question. Under which of the following circumstances is a misstatement material? Who can answer this? I'll refer to the chat. Please give me an answer in 5 seconds, please. No? C is wrong answer. Yes, who answered that? B, Sarah. Yes, this is the correct answer. This is the answer that I'm looking for. Fine, so let's move. So you all got that? It is materially misstatement if it could individually or collectively influence the economic decision that user makes on the basis of financial statements. Some external auditors, the firm that audits the financial statements, they have threshold just to measure the materiality. Some of them, they put like 10% out of profit or 5% out of the total assets. But as a user of financial statements, it would be materially misstatement if it could change my decision making. I hope this is clear. So let's move to next subject, which is the consolidated financial statements. This has to do with the IFRS 10. Okay, so from the name, I mean, without going into this all these readings, I may focus on certain concepts only. What do we do when we consolidate usually? Or what does it mean, consolidation? It means that you have like two or more entities that when you consolidate, they become like one economic entity. So you consolidate line by line, like by like, assets, liabilities, expenses, revenues, and all the items on the financial statements. The IFRS 10 was issued in 2011, and it was effective from beginning of 2013. And as I mentioned, it is the purpose of this IFRS is to guide the presentation and preparation of consolidated financial statements, which an entity controls one or more other entities. Am I going too fast, or it's okay with you? Is it okay? Please write on the chat. Okay, fine. Okay, so what is the scope of the standards? As I mentioned, it requires a parent entity or an investor. Sometimes maybe you can hear from me saying that parent or investor. So if that parent company which is the mother company, owns or controls one or more other entities, that parent company is required to consolidate the financial statements. And the standard defines the principle of controls, how to apply the principle of controls and the accounting requirements for preparation and consolidation of financial results, and also define the investment entity that are an exception to consolidation. These are like only key definitions for you to read, but this is very important. You have to remember that. How to measure controls. We said the keyword is control, and the parent company or the investor is required to consolidate when the investor or the parent company is exposed or has the right to variable returns from its involvement with the investee and has the ability to affect those returns. This is very important. It has to have the ability to affect those returns. It's not only the control is the key. If they have enough shareholding stake in that company, but it cannot impact the decisions, or that does not have the power to impact the decisions that are impacting the returns, we cannot say that the parent has control or significant control. Okay, so as I said, these are definitions for you to read. If you see the definition of power here, it is existing rights that give the current ability to direct the relevant activities. And the relevant activities are also defined as the significant activities that the investee, that contributes to the investee total income or profit. Why I'm putting here some like definitions or scope for defining investment entities. Just to brief you, without going into all this, as an accountant or like head of finance, you have like three options. If you are a company, a parent company or an investor, and you are putting some cash on an investment opportunity, I'll just put it in that way so that you understand. As an accountant, you have three options, and I'm going to cover them in details. Option number one, whether that investment will be subject to consolidation under IFRS 10. Does it fall under that definition, or is it an associates, joint ventures, whereby you have controls but you are not required to consolidate? We will cover that part of the equity accounting method. And number three, whether that is cash that you invested or you injected in a business or an opportunity is merely as an investment that is not governed by the consolidation and not governed by the investment in associate and joint ventures. So three options: whether you can consolidate or account for it as part of equity accounting method, if it's an associate or joint venture. And the third option is a normal mere investment, which is subject to revaluation. Whether revaluation impact goes to your P&L or to your other comprehensive income. Okay, so these are like the summary of all this. Okay. This is important also. It is like a recap of what I have covered. A parent need not present consolidated financial statements if it meets all of the following. When you are not required to consolidate, if you are a wholly owned subsidiary, if the parent is a wholly owned subsidiary or a partial owned subsidiary of another entity. So it is being consolidated by others, so they cannot consolidate. If its debt or equity instruments are not traded in public market. Okay, 2 and 3, they are related, because if you are listed in a stock exchange, you will be required to file your financial statements within the security commissions. Okay, so if you are not listed and you are not reporting to any security commissions, you are not required to consolidate. Okay, and as I mentioned, if you are accounting basically for it as investment, it would be subject to revaluation through profit and loss in accordance with the relevant IFRS. Okay, so investment entities are prohibited from consolidating particular subsidiaries and shall measure investment at fair value through P&L. Okay. Okay, so how to go about the consolidation now? You have 2 entities, you have 2 sets of financials, one of you as a parent company, and you have like subsidiaries. So what do you do? How to do the consolidation? Basically, you follow these 3 steps. You combine like items of assets, liability, equity, income, expenses, cash flow with those of its subsidiaries. And we should eliminate the carrying value of the investment in subsidiaries against the capital of that subsidiary. I'll show you example on that. And very important is to eliminate the full intergroup assets and liability that are between intergroups, between the parents and the subsidiary. So just to avoid like over accounting, over reporting your income or underestimating your expenses. So you have to eliminate the intergroup transactions between parents and its subsidiaries. Next, we cover that. Here is very important. The parent subsidiary are required to have same reporting dates, unless if it's not practical. What to do? I mean, if it's not practical, most financial statements of the subsidiary are reused, adjusted for the effects of significant transaction or event between reporting dates of the subsidiaries and consolidated financial statements. And it's important that the financial years or the closing years of both parents and subsidiaries are the same. There should not be like a gap more than 3 months. I'm sure you heard about the word non-controlling interests. For example, now a parent company, BBK, for example, like it owns, let's say, for example, 70% of another subsidiary. So the 30% is called non-controlling interest. So that minority interest or non-controlling interest has to be shown, their share has to be shown in the financial statements and the financial positions. Okay. If I, for example, now, second, if there is changes in the ownership interest, we said ownership interest is the key, and the controls is another key. So if there is change in the ownership interest, like I own 90% or 100% of another subsidiary, and then I decided to sell down 10%, so it becomes 90%. Does that means that I shouldn't consolidate? No. Still, they are your subsidiary, and as I mentioned, you have to show the 10% as a minority or non-controlling interest. Okay, this is for your reading.